Hey guys, it's the Simple Investor here. Today we're going to be taking a look at Uber, who just reported very strong earnings. But before we do so, be sure to like and to subscribe to the channel as it really helps it out. But let's get to it. So Uber reported strong earnings today, what was actually seen as a reflection as to how the consumer is doing in terms of inflation, to see if they're affected in a very negative way, because Uber is more of a cyclical stock. It's very sensitive to the interest rate cycle. It's more of a discretionary stock too when it comes to specifically to their delivery segment. But nevertheless, they reported very strong earnings here. The market actually, they jumped a little bit here on the news today. They were up almost 11%. But to their earnings here, so they reported nice earnings here. Gross bookings were up 19% year over year, and then 21% on a constant currency basis. So strong in that respect. And then if we go down here to the nitty gritty, there the two things here that really stood out to me was the increase in their free cash flow here. So that was up 51%. And then their adjusted earnings before interest, taxation, depreciation, and amortization was up 71%. So again, they're squeezing a lot more revenue, and obviously that's reflected here. They grew their revenue here 16%. And then with the constant currency up 17%. So again, that's quite impressive. And then specifically what I was really watching for here, just to see if this was a reflection on the current inflation situation. With high inflation, they actually grew their delivery segment, which I believe was the most weak out of their whole business. They actually grew 16%. So that's quite impressive, considering that the consumer is pinched according to a lot of data. But people are obviously spending money on Uber. And so it's a really solid quarter for them. I mean, they also here are doing some shareholder-friendly things like repurchasing $325 million worth of stocks. That's what you like to see. Personally, too, I like seeing stock buybacks over dividends because it actually, in the long run, will actually appreciate your stock faster rather than a dividend, which is just a little bit of money that they give you. But personally, I actually prefer that they just put the money back into the business. I like out of the two dividends and share buybacks, I'm more of a fan of buybacks, but I'd rather actually than just put it back into the business. But breaking down here how their earnings went, they had most of their money coming from like Ubers. So you call an Uber and they come pick you up. And then second was Uber Eats, so delivery, food delivery, and then Uber Freight, which is if you want to send a package to someone through their service. That actually had no growth year over year. And then you can see how that actually trickles down to their net profit of $1 billion, which they increased 5 percentage points year over year with a 9% margin. And you can see kind of where they're spending their money here. They spend most of their money on marketing here, and then second most on research and development. And again, cost of the revenue is costed about 6.5 billion, operating expenses to 3.4, and then they're collecting that net billion with that little bit there, 100 million going towards interest with money that they've borrowed. As a technology company, I'm not surprised that they have a negative interest situation here, or where they're paying interest. You see more in these big tech companies like Google. They are actually collecting quite a lot of money. They're collecting $100 million on interest just because they have billions and billions of dollars in cash that they're keeping, and they're actually taking advantage of this 5% inflation or 5% interest rate right now. And then actually breaking down that free cash flow, which is something that I really was impressed with. You can see how it's actually really, really like if you look at quarter two of 2023, it was 1.1 billion, and now it's up to 1.7 billion. So again, it's growing quite nicely. It's a company that you want to see more spending on research and development, and we're gonna get into why they actually need to start spending on research and development, and they really need to start thinking about how they're going to innovate and take Uber to the next stage, because they've got some kind of scary competition on the horizon. But actualizing this a little further, earnings per share, again, this is always masked when companies buy back stock, 47 cents versus 31 cents expected. And then that revenue, Wall Street expected 10.57 billion, and they got 10.7. So again, it was a strong quarter in a time when we were expecting maybe the consumer to be a little bit pinched, but they seem to have delivered. But what concerns me with Uber is kind of the emergence of Waymo. If you're not familiar with Waymo, Waymo is a self-driving taxi service that's funded by Google. And Waymo actually announced today that they were expanding their services in different areas in San Francisco and Los Angeles. So this here is what I think is the biggest competition to Uber is autonomous driving. And these are getting more and more popular across California, and they're starting to expand outside of California. People can just order them like an Uber on an app on their phone, and they'll come pick you up, and there's no driver in the car. And essentially, what this is going to do to Uber is more people are going to go take these Waymos because they can cut down the cost. And then you see too, there's lots of issues where Uber drivers are getting compensated or they're double tippy, double charging. There's lots of issues with that. This completely eliminates it. And these are actually quite popular in San Francisco and LA. And then the other thing where I think Uber is really going to be affected is once this is a long way off, but would be Tesla's robotaxi. So if you guys aren't familiar with robotaxi essentially is people who own Teslas and have FSD, full self-driving mode enabled. They can leave their car and submit it into the network while they're not driving it, of course. And basically, people will Airbnb their car, their Tesla, and it will pick people up who are looking for a ride, much like they would be for an Uber. And so basically, how it works is Tesla will take a cut of that, and then obviously the people who are renting out their car to shuttle people around will take a cut of that as well. So again, that's a long way off, but those are some things where you really want to see Uber start to think about really spending money on their research and development because they've got Waymo, which is funded by Google, and Google has a treasure chest full of money which they can spend at full self-driving and autonomous driving. And then Tesla as well, which is really trying to invest in this. Obviously, this was supposed to be happening in August, but it got pushed back. But again, these are two things that really kind of deter me from wanting to invest in Uber, even though they had really strong earnings. And then two, as well, if you actually compare them, because one of my benchmarks for when I'm looking at stocks is if it can't perform the S&P 500, why would I invest in that company? Because I could get a better gain, a safer investment if I was to just buy the S&P 500, and I don't have to worry about doing research on balance sheets and looking at the forward trends of where a company's going. I can just sleep well knowing that I'm invested in the 500 largest companies in the United States. So again, here they actually haven't beaten the S&P 500. The S&P 500 has actually beat them quite substantially here. So again, that's always something to keep in mind. I know for me, it's really important that I want to have a really firm conviction in the long term in a company that I invest in. I formerly held Uber and I sold it off when it popped a little bit earlier in the year. And I'm not planning on investing in it again. I really just don't see strong growth potential. And again, you're paying a really high price over earnings for it. It's quite expensive right now, but mind you, it is a technology company. So you are always going to have to pay a little bit more for those. But Uber isn't a company that I really see as a buy after these earnings. Those earnings were strong. I mean, you can always think about trading these companies where you don't intend to hold them long term, but if you see a potential short-term gain, they're always worth considering holding. But long term, I don't really see how Uber is going to be able to compete with autonomous driving unless they can really innovate. And mind you, that's not even considering the fact that you see the emergence of companies like Lyft too, which are directly competing against them. And then two, you see other companies like DoorDash, which are competing with them in the food delivery service. So again, the features are kind of bleak, but if you hold QQM or you hold a NASDAQ 100 index, you are going to get some exposure to Uber as well. So that's always something to consider. But let me know what you guys think. Is Uber a buy after earnings? Is it a sell or is it a hold? Let me know in that comment section below. Be sure to comment, like, and subscribe if you haven't already. We'll see you guys next time.